which is for Nifty 50. Before that, please go through this disclaimer here. So, what are index funds, especially the index fund, Nifty 50 index fund? They track the Nifty 50 index, that is the top 50 companies in India. So before we go into selecting the index funds, uh, we will just see why we should invest and what are the benefits and disadvantages. So these are the companies which we daily see and use. So if I go to this Grow website, here you can see the companies in Nifty 50 are uh, HDFC Bank, Reliance, ICICI Bank, Airtel, Larsen and Turbo, SBI Bank, ITC, Mahindra and Mahindra, uh, Kotak Mahindra Bank, Maruti Suzuki, Hindustan Unilever, Eternal. Eternal is nothing but Zomato, Sun Pharma, the medicines which we use. So these are the companies which we daily use. Whatever names we are seeing here in this Nifty 50, these companies we use their products daily. So I feel as a citizen of India that I also need to be part of their profit because even I use their products. That is my thing here. So that is one of the thing which I feel that we need to invest in these index funds, Nifty 50 index fund, which is. So the second thing, if you see, uh, it keeps investing very simple for us. So it doesn't complicate the uh, investing file because here what happens, we are just matching the index. Whatever the index is there, the fund actually matches the particular index. So it becomes very simple, and in investing, it is very important to keep things simple. So we'll just look at the benefits. They have low expense ratio. So since they are just mapping the Nifty 50 here, they will have low charges which are charged by the manager. That is one. Invests in large top quality stocks in India. These all are top quality stocks in India. Only market risk and no fund management manager risk. What happens in other types of active mutual fund is that manager also we need to see what kind of manager he is, whether the manager changes over time, what is his philosophy, all those things. But in index funds, there is no manager risk, there is only market risk. This is one advantage, avoiding the tax. I brought this point in because we can avoid the tax. Say you have invested in some active mutual fund, good active mutual fund. Say after 1 year or 2 years, that particular fund manager changes. So that time, what you have to do is you have to move your money from one mutual fund to other. That time, what happens? You might have to pay the tax. Here in index funds, it will be like you can invest the money for say next 10 years, 20 years, which will defer the tax. We won't pay the tax for that time. So we can defer and avoid the tax for long time. Instead of selling one active fund and buying other, we can do this. So there is disadvantages as well. Invests in bad companies as well, since size of companies is large. Some company size is large and we do get some bad companies as well sometimes. So this is one of the disadvantage. Along with gold, sometimes we might get some cheap stocks. So, and one more benefit which I wanted to tell is this can be our large cap portfolio since it beats most of the actively managed large cap mutual funds. So to see that, we'll go to a website. Here I'll select large cap and this will be direct plan. I am selecting 8 years. So we will check few funds. So these are large cap funds. So if you see Nifty 100 index here, in this video we will be selecting for Nifty 50. But even if Nifty 100 is there, you see over last 8 years it has given 12.75%. So you can see, you can say that, hey, Canada is earning 15% here and things like that. These all are more than 12. But these are just 8 or 9 funds here. Just if you come to the next page, for this, you can see here it is 12.74. So the all the funds from here, if you see down, have not even beaten the index. And if you can check, their expense ratio is 0.96, I think close to 1% for large cap to maintaining, and they are not able to even beat the Nifty 100 index fund here. So I feel it is better to take your large cap uh, percentage of your portfolio in the Nifty 50 or Nifty Next 50 index funds, because these people are charging such high values. If I go to the third page, these people are earning like 11% and some it is 9% also. Say Taurus large cap. So uh, this has a AUM of 52 crores and they are charging expense ratio of 2% here, 2.5%. And people around 52 crores they are managing here. So expense ratio is also high and they are not able to beat the index fund as well. So now we will go into how to select the best index mutual fund for Nifty 50. Before that, I'll show you the returns of Nifty 50 in this Grow website itself. So if you see here, so if you see 3 years returns, it's 3.41%, 5 years will be 13.42% annually. So from last 5 years, if you had simply put your money, you would have made this 13.42%. And from say, from when is it? Uh, From 2013, if you had just put your money here, you would have made around 12.79 annualized returns here. So just being in the mutual index funds will give you these returns, which is much more than FD, which is beating the inflation, and it is simple. No more mehnat here. So how to select the best Nifty 50 index fund? There are a lot of index funds which are associated with Nifty 50. How to select the best? We will see it here. So we will go to ticker tape for this. So in this you will go, so you'll go to more and you will select mutual fund screener here. So here it's mutual fund and you'll click on start screening. So we want equity here. We want index fund here. This is index funds. There is one more for debt. We will select for equity only. So these are all the mutual funds which comes to us. These are all index funds. So what we'll do in the filter here is in the OM. OM is nothing but the amount of money that particular mutual fund is handling. So for OM, we will, if you come down, there is high. You can select it high. So we will get the list of mutual funds here, which are index funds. So you can see the first four are Nifty 50 mutual funds, and fifth one is Sensex based index fund. So in this mutual funds, We need to add one more filter here, which is called as tracking error. So once we add it, it comes here. So if I go back to the sheet, so these are the conditions here, like the OM should be high, expense ratio should be low, and tracking error should be low. OM should be high because the volatility of that index fund will be less when compared to the particular index which we are comparing. So OM, it is always better if it is high. Expense ratio as the cost should be low, maintenance cost. And tracking error should also be low. It should not be like the tracking error is too high that it is not mapping the index at all. So here in ours, if we see all the four have the same tracking error, so it is the same here for all. But say the OM was very less, the tracking error could be higher for this. So we should always go with those mutual funds for which the OM is high. So next, if you check the expense ratio, I think ICICI and SBI has the least expense ratio here. And they have a good arm also, more than 10,000 crores. Here it's 15,000 crores. So these are good index fund. So if you see all the four index funds are good here. All four have good arm. So slight difference in expense ratio. So we can consider any one. You cannot go wrong in selecting any one of this. So yeah. So thanks for watching this video. Bye.